As the largest lender, SBI has a lot of firsts to its credit, and it has added one more recently with its decision to link a portion of its bank deposits and select loans to an external benchmark, the repo rate. Let's do a three-point analysis of the reasons behind SBI's move, and will that prompt other lenders to follow suit? 1. What will SBI do? Well, SBI has decided to price savings account with deposits above 1 lakh rupees at 2.75% below the prevailing repo rate of 6.25%. The effective rate works out to be at 3.5%. SBI is actually placating the regulator without hurting its shareholders. According to SBI, close to 33% of savings balance is above 1 lakh rupees. Essentially, the move would impact close to 12.8% of its total liabilities. On the asset side, SBI is linking external benchmarking to a similar sized exposure, thereby balancing the asset and liability without hurting margins. On the advances side, the bank has announced cash credit accounts and overdraft facilities over 1 lakh rupees to be priced at 2.25% over the repo rate. At the repo rate of 6.25%, this would mean a floor price of 8.5%. The bank would charge a risk premium over the floor rate, depending on the credit quality of the borrower. 2. What's the reason behind SBI's move and how will it impact account holders? Well, the RBI in its fifth bi-monthly monetary policy statement in FY19 had recommended the use of external benchmark for swifter transmission of policy rates. RBI had suggested banks to price their floating rate of retail or MSME loans based on an external benchmark. With SBI linking rates starting 1st of May, change in repo rate will be automatically transmitted. 3. Will other banks follow suit? Well, that's the key thing to watch out for. There is an expectation, however, that banks with stable liability franchise will follow suit. Most private lenders with superior liability profile will take on this challenge from SBI with elan. Banks with weaker liabilities could feel the pinch and would be more disadvantaged as well as could lose the market share. Now, having said that, the weak competitive landscape and tighter liquidity as well as demise of weak NBFCs are resulting in the return of pricing power to the banks. So far, the challenge thrown by SBI doesn't seem to be disruptive, and it is unlikely to impact spread of the banking sector at this stage.